Welcome to the Deep Dive. If
Yeah.
you're joining us today, you are probably looking for the real signal in a world that is just absolutely overwhelmed by noise.
Right. And that is our entire mission here.
Exactly. Today, we are taking a massive stack of financial intelligence. Specifically, we are looking at the editions of Business Standard and the Economic Times from March 7, 2026, and we're extracting the pure, concentrated insights.
Just the signal.
Just the signal, no ads, no local classifieds, no fluff, just the hard-hitting facts that move markets, reshape industries, and ultimately impact your bottom line.
Because the goal today is moving beyond the headlines. We want to help you understand not just what is happening in the global and domestic economy right now, but why it actually matters for your portfolio and your business strategy.
Yeah.
We're looking at a profound set of shifts today. I mean, we're talking global energy shocks, a structural repricing in equity markets, major corporate IPO maneuvers, and a regulatory landscape that is it's changing the rules of the game overnight.
Okay, let's unpack this. We got to start with the geopolitical situation because it's casting this massive, unavoidable shadow over literally everything else right now.
It really is.
The hard facts coming out of West Asia are grim. The U.S. and Israel attack on Iran has now entered its 7th day. In a direct retaliation, Iran has blocked U.S. and Israeli-flagged ships from passing through the Strait of Hormuz.
Which is a massive choke point.
A huge choke point. And the immediate casualty, as you might guess, is the energy sector. Brent crude has just breached the $90 a barrel mark. It hit $90.60.
Yeah.
To put that in perspective for you, we are looking at a $25 climb in just a single week.
Yeah.
That's the sharpest jump since the start of the Ukraine war back in March 2022.
And if we look past just the raw commodity price, the physical reality of moving that oil is turning into a total logistical nightmare. It's one thing to buy oil, it's another to get it on a tanker and safely navigate a conflict zone.
Right, the insurance aspect.
Exactly. GIC Re, the General Insurance Corporation of India, is entirely withdrawing marine cargo war cover in the Persian Gulf. Think about the cascading effect of that.
Wow.
The Persian Gulf handles roughly 20% of the global oil trade. Without that insurance safety net, freight costs and war risk surcharges are just skyrocketing. Shippers have to absorb massive risk premiums, and that bleeds into every other sector.
It hits everything.
We're already seeing commercial airfares to Europe jump by 40% simply due to airspace closures and the need for massive rerouting.
The ripple effects are immediate. They hit the consumer and the corporate balance sheets so fast. But amidst all this supply chain panic, there is a very surprising geopolitical maneuver regarding Russian oil.
The waiver.
Right. The U.S. Treasury has just issued a temporary 30-day waiver that explicitly allows Indian refiners to buy Russian crude that is currently stranded at sea.
Which is a huge development.
Huge. And because of this sudden opening, Russian crude imports into India have surged dramatically. We're talking 1.37 million barrels per day in just the first 6 days of March.
It's a brilliantly pragmatic move by the U.S., frankly. They recognize that the global energy market is balancing on a knife's edge here.
Yeah.
By granting this specific waiver, they provide a short-term logistical release valve. It keeps global supplies flowing just enough to prevent Iran from essentially holding the entire global energy complex hostage.
Makes sense.
However, from a domestic macroeconomic standpoint, the finance ministry has put out a very stark warning. If this conflict is prolonged and crude stays elevated at these $90 levels, it's going to place massive sustained pressure on inflation.
Which directly hits India's current account deficit, the CAD. Because oil is priced in dollars, every time that barrel price ticks up, our import bill skyrockets.
Yeah.
And we drain those dollars at a much faster rate.
That is the traditional vulnerability, yes. But there's a crucial counterweight to that fear today. We aren't looking at a repeat of the 1991 Gulf War oil shock, which, triggered a massive balance of payments crisis for India.
Right, we're in a different position now.
Completely different. We are entering this specific period of turbulence with a historically unprecedented macroeconomic shield. India's Forex reserves just hit an absolute record high of $728.49 billion.
$728 billion. That is a phenomenal safety net to have. It essentially means the Reserve Bank of India has the heavy artillery needed to defend the rupee, manage imported inflation, and just absorb the immediate shockwaves far better than in any previous decade.
Exactly. That reserve pile changes the entire psychological landscape for foreign and domestic investors. The central bank isn't operating from a place of desperation, it's operating from a fortress.
Even with that fortress, though, the equity markets are certainly feeling the panic of the moment. The Sensex and Nifty 50 just logged their worst week in over a year, dropping nearly 3% across the board.
Yeah.
The sell-off was intense.
Very. The numbers show that foreign portfolio investors, the FPIs, dumped roughly 21,831 crore rupees in equities in just 1 week. But then you look at the other side of the ledger, and domestic institutional investors, the DIIs, stepped in and bought heavily. They essentially acted as a giant shock absorber.
What's fascinating here is the rising dominance and resilience of the domestic Indian investor. It's arguably the defining financial story of this decade. They are preventing what would have historically been a market freefall.
Right.
But if we dig into the anatomy of that foreign sell-off, a much more nuanced story emerges. The foreign institutions aren't just selling everything indiscriminately because of oil or geopolitical panic. They are heavily targeting one specific sector.
IT.
Yes. They pulled out nearly 16,949 crore rupees from information technology stocks since mid-February.
Here's where it gets really interesting. You read the underlying research on this, and it becomes clear this isn't just a reaction to high crude prices. This is a deep structural fear of artificial intelligence.
We are moving way past the era of AI just acting as a glorified autocomplete for code. The major AI labs are increasingly automating entire chunks of the software development lifecycle.
And that cuts straight to the bone of the traditional Indian IT business model. Historically, that entire industry has been built on headcount. It's the classic billable hour body shop model.
Right, deploying armies of coders.
Exactly. A major firm wins a corporate contract, they deploy 5,000 engineers to maintain legacy systems or build new apps, and they bill the client for the time of those 5,000 people.
So if AI can drastically reduce the number of developers needed to execute a project, say you only need 500 engineers instead of 5,000, the revenue and profit models of these IT giants face massive deflation.
Precisely.
Even if their margins improve slightly because they are employing fewer people, the absolute top-line revenue shrinks drastically.
And analysts are already baking in 3 to 3.5% revenue deflation for the IT services industry in the coming years simply due to this efficiency gain. Foreign investors are reading the writing on the wall.
So they're rotating out.
Aggressively rotating their capital out of IT, which has been the darling of the Indian growth story for decades, and deploying it into domestic demand sectors. They're buying into capital goods, financials, and auto components, where the AI threat to the core business model is significantly lower and domestic consumption remains incredibly high.
That structural rotation is going to dictate portfolio performance for the next 5 years, easily. Speaking of massive structural shifts, let's pivot to some major corporate restructuring and IPO news.
We have some big developments here.
The highly anticipated 2026 mega IPO for Jio Platforms, Mukesh Ambani's digital arm, is officially facing a delay.
The bottleneck here is entirely rooted in regulatory mechanics. SEBI, the market regulator, recently approved an amendment regarding public listings. Usually, to go public, a company must dilute a minimum of 5% of its equity into the open market.
Right.
But SEBI created a carve-out, a new rule allowing companies valued at over $55 billion to dilute only 2.5%.
Just to clarify the legal status on that for anyone tracking this, the problem is that the finance ministry hasn't gazetted this rule yet, meaning the government hasn't printed it in the official public record.
Correct. It's not enforceable yet.
It's an approved idea, but not law. But if I'm looking at the math on that SEBI rule, dropping the requirement from 5% to 2.5% seems like the only viable way a massive conglomerate can list today.
Oh, absolutely.
If a company is valued at $100 billion, a 5% dilution means they have to offload $5 billion of stock all at once. That's an astronomical amount of equity to sacrifice, and frankly, it risks flooding the market and depressing the initial share price.
That is the exact corporate calculus happening behind closed doors. By dropping the requirement to 2.5%, it allows these massive capital-heavy entities to go public, establish a baseline market price, and provide liquidity to early private equity backers without giving up too much control or saturating the institutional demand.
So Jio's waiting.
Jio is essentially keeping its powder dry, waiting for that bureaucratic ink to officially hit the Gazette before they make their move.
That structural shift in IPO mechanics is a great segue into how other massive tech players are prepping for the public markets. Look at Flipkart.
Yeah, the layoffs.
The e-commerce major is currently laying off about 250 to 300 employees, which is roughly 2% of its total workforce, following a round of performance reviews. Now, the knee-jerk reaction to layoffs is usually panic about the health of the consumer, but in this case, it feels like a very different strategic play.
It is entirely strategic. In the context of a massive enterprise employing around 20,000 people, a 2% cut post-performance review is standard operational pruning.
Right.
But when you zoom out, this is a classic pre-IPO streamlining move. Flipkart has been systematically trimming its senior management layers over the last 2 years. They're bringing in specialized operational executives and focusing ruthlessly on the path to profitability.
Making the books look good.
When you are preparing to pitch your company to public shareholders on the open market, you don't want a narrative of gloated tech boom spending. You want the narrative to be about a lean, highly efficient, and profitable machine.
It's all about dressing the bride for the IPO. It is a sign of preparation, not distress. Now, let's look at the environment these tech companies are operating in, because the regulatory landscape is tightening aggressively.
Very aggressively.
Big tech is facing a serious headache at the state level. Karnataka is proposing a sweeping ban on social media use for children under 16. And Andhra Pradesh is looking at a similar ban for children under 13. This comes right on the heels of similar legislative moves we've seen recently in Australia and parts of Europe.
The sheer enforcement challenge of a law like this is staggering. How does a single state realistically enforce a digital border?
They can't, really.
The compliance burden this creates for platforms like Meta, Alphabet, and Snap is immense. They're going to have to implement incredibly robust, foolproof age gating and geofencing technologies just to operate legally in these specific jurisdictions.
And beyond the technical and engineering headache, this directly threatens the core valuation models of these ad-driven platforms. If you forcibly cut off access to millions of teenagers who are arguably the most engaged demographic, the user growth metrics in one of their most important global markets take a massive hit.
Now, the banking sector is getting its own aggressive regulatory shock alongside tech. The Reserve Bank of India has proposed a radical new rule. Banks must compensate customers up to 25,000 rupees for digital frauds within 5 days.
And the critical detail here, the bank must pay out, even if the loss occurred due to the customer's own negligence.
Exactly.
That is a profound shift in liability. Historically, if you accidentally handed over your OTP to a scammer on a phone call, the bank would investigate, conclude you were negligent, and that would be your loss.
Right.
The RBI is essentially changing the role of the bank. This rule forces banks to act as the active bouncers at the door of your digital wallet, rather than just the passive vault holding your money.
That is a perfect analogy. The RBI realizes that the sheer volume of these micro-frauds is destroying trust in digital public infrastructure. By forcing the financial liability directly onto the bank's balance sheets for these smaller, high-frequency scams, they are changing the bank's incentives.
They have to care now.
If a bank is suddenly on the hook to reimburse millions of rupees a week in small frauds, how do they respond? They're going to massively accelerate their capital expenditures in back-end cybersecurity and AI fraud detection.
Because they have to stop it instantly.
They have to stop those fraudulent transactions in milliseconds before they even process. This is going to trigger a massive multi-year CapEx cycle in banking technology.
Speaking of bringing the digital world under strict regulatory control, the government is also tightening the net on digital assets. Crypto assets and central bank digital currencies, the CBDCs, have now been officially brought under the strict automatic tax reporting framework.
Finally aligning with global standards.
Yes, this completely aligns India with the OECD's global standards.
The era of the digital Wild West, where assets could be hidden on obscure exchanges, is officially over. By amending the income tax rules to include these digital assets in the automatic exchange of financial account information, mandatory institutional transparency is here.
You can't hide it anymore.
If you hold crypto, it is going to be tracked, categorized, and reported across borders just like a traditional bank account or a mutual fund. It removes the regulatory ambiguity that has clouded the sector, which is actually a positive for long-term institutional adoption, even if it frustrates retail traders used to anonymity.
We'll close out this deep dive into regulations with a market reaction that was overwhelmingly positive. Karnataka just overhauled its 60-year-old liquor excise policy.
This was huge news for the sector.
They are moving to an alcohol and beverage, or AIB, structure, and they're completely deregulating the pricing slabs. Investors absolutely loved it. Major liquor stocks like Radico Khaitan and United Breweries jumped 6 to 9% on the news alone.
It is a brilliant, long overdue structural shift for the industry's profitability. Under the old system, taxing by total liquid volume meant that a large bottle of cheap, low-alcohol beer was taxed disproportionately heavily compared to a small bottle of highly potent premium spirits.
Makes no sense.
Right. By shifting to a system that taxes strictly by alcohol content and combining that with allowing companies to set their own market prices rather than waiting for slow government approvals, Karnataka has created a massive catalyst for premiumization.
It encourages these beverage companies to aggressively market higher quality, higher margin products, knowing the tax structure won't unfairly penalize their premium lines. It structurally pads their bottom line.
Moving from policy to the ground floor, there are a few other crucial rapid-fire business movements we need to cover.
Let's run through them. First, Tata Power is partnering with the U.S. tech giant Salesforce to digitally transform and scale its clean energy business, specifically focusing on rooftop solar and EV charging networks.
That is a prime example of the convergence we are seeing across the economy. Pairing hard physical infrastructure with elite cloud software to efficiently manage distributed energy grids. You can't build a modern power network without a massive software layer.
Next, the entertainment landscape is shifting. Netflix is opening a massive, high-value global VFX and virtual production hub right in Hyderabad,
Which firmly cements Hyderabad's status not just as an IT backend, but as a global powerhouse for the higher margin animation, visual effects, gaming, and comics sector. The talent pool there is world-class.
Looking at the IPO space, which we know is eager for quality listings, Cedimac Mechatronics saw its IPO oversubscribed 2.7 times, despite the broader market turbulence we discussed earlier.
That proves there is still incredibly strong institutional appetite for highly specialized, control-intensive auto tech platforms. Investors will always find capital for niche, high-mode engineering.
And finally, a fascinating story at the intersection of tech and state power. The AI giant Anthropic is legally fighting the Pentagon over a decision to declare the company a threat to the U.S. supply chain under rules usually reserved for foreign adversaries.
It's a stark reminder of the escalating tension between national security apparatuses, which want to control foundational technologies, and the rapid, borderless scaling of private artificial intelligence companies. The state wants oversight. The tech companies want friction-free growth.
So what does this all mean? We have covered everything from West Asian conflict and oil shocks to the existential threat of AI and sweeping regulatory overhauls. As promised at the top of the show, we need to distill this massive stack of information down. Can we build the definitive list of the 10 developments from today that are absolutely most relevant for long-term investors? Let's take them one by one.
I'm ready. Number one has to be Brent crude breaching the $90 mark. If it sustains at this level, it is a direct, immediate threat to India's current account deficit and domestic inflation metrics.
I agree. Number two connects directly to the markets. AI's existential threat to the IT headcount model. This is a structural shift causing foreign investors to dump IT stocks. The era of the billable hour body shop is facing a severe deflationary threat.
Exactly. Number three is the SEBI 2.5% dilution rule. Once it's officially gazetted, this will unlock mega IPOs like Geo by drastically lowering the massive equity sacrifice previously required to go public. It changes the math for conglomerates.
Number four is the wave of state-level social media bans in places like Karnataka and Andhra Pradesh. This is a looming regulatory and technical nightmare for big tech that could severely cap user growth and ad revenues among Indian youth.
Number five is the RBI's 25,000 rupee fraud liability rule. By shifting the cost of digital negligence directly to the banks, the central bank is forcing a massive, immediate capital expenditure cycle to upgrade back-end cybersecurity and fraud prevention AI.
Number six brings us to Karnataka's liquor deregulation. The shift from volume-based to alcohol content taxation paves the way for premiumization, translating directly to structurally higher profit margins in the alcobev sector.
Number seven is the new crypto tax reporting mandate. Digital assets are now fully integrated into the global tax tracking net. The Wild West phase is over. Mandatory institutional transparency is here.
Number eight is India's record $728.49 billion Forex reserves. This is the country's ultimate macroeconomic shield, ensuring the central bank can weather the current West Asia oil shock far better than in historical crises like 1991.
Number nine is the withdrawal of marine war cover by GIC Re. This signals that elevated supply chain logistics and soaring freight costs in the Persian Gulf are not a temporary blip. They are here to stay for the foreseeable future.
And finally, number 10, the DII market cushion. The continued massive ability of domestic institutional investors to absorb aggressive foreign sell-offs proves the structural maturity, depth, and resilience of Indian capital markets today.
It is an entirely different financial ecosystem than it was a decade ago.
It really is. And seeing all those structural shifts laid out so clearly helps cut right through the daily noise. Thank you for joining us on this deep dive. We appreciate you spending your time with us to get truly informed.
It has been a pleasure diving into the nuances with you. And I want to leave you with a final thought to mull over, specifically regarding that structural shift in the IT sector we discussed. If AI can automate software development enough to trigger mass foreign sell-offs in Indian IT stocks, what happens to the real estate, retail, and consumption patterns in India's major tech hubs if that high-income workforce begins to shrink? Something to consider.
Until next time.